Again, why do these markets keep melting up? Well, I think it's because we're going to get a melt up. We're going to get an inflationary crack up boom. That's what it is. And yes, you'll do okay in the stock market, but I think in gold, silver, and the miners, you're going to do even better in relative terms. That's the way I see it. And that's what the bond markets are telling us, the longer end. Wednesday, August 13th, 2025, Maneco 64, home of alternative economics and contrarian views. We had the CPI data yesterday, and there's a lot of talk now that the Fed will be able to cut rates come September. And I think, yeah, they're desperate. And I'll tell you why they're desperate for rate cuts. But I also want to talk about the bond market. The longer end of the yield curve is showing signs of stress, not just in the United States, but also in the UK and also Germany, which is very surprising. Germany historically has been a very frugal fiscal actor, if you want to call it that. And we're going to look at the miners, gold and silver miners. They're pointing to a major resumption of the bull market in gold and silver. But before I go further, just wanted to let you know, Rudy's a lot better. He's still taking antibiotics, but he's his old self. He's not on the sofa because it's already quite hot. We've been out for a walk, and he's just lying here next to me on the floor, wooden floor. It's a bit cooler for him. And talking about Rudy, just wanted to make you aware that we have a merchandise store now, and we have a lot of stuff with Rudy on it. And one of my favorites is the this End the Fed mug, and this is supposed to be Charles Lindbergh Sr., a congressman from Minnesota back in the day when they passed the Federal Reserve note. And I'll just read here on the mug a quote that he made, a famous quote in my opinion, and it says, "This Federal Reserve Act establishes the most gigantic trust on earth. When the president, Woodrow Wilson, signs this bill, the invisible government of the monetary power will be legalized. The worst legislative crime of the ages is perpetrated by this banking and currency bill. Charles A. Lindbergh Sr." So, yes, there's a lot of talk about what will the Fed do. Trump is going to, emasculate, or what's the word? Trump is going to make the Fed weaker. He's going to take over the Fed. It could be, but I would say I agree with Ron Paul, who turned, I think he turned 90 the other day. Yes, the only good Fed is a dead Fed, or end the Fed. And talking about Ron Paul, I'm going to try to get him on. I've had him on the channel. I think it was during COVID, actually. And I also had the I was fortunate to meet him in 2002 when I went to the Mises Institute 20th anniversary conference. I went with my wife, and he was there. Very nice man. One of the very few honest politicians, really. Anyway, yeah, if you're looking for a nice mug to maybe even give it to friends so they can learn about what's going on, check out the merchandise store. There's a link below in the description. So back to CPI. Yeah, it came out at 2.7, the headline CPI. It was expected to be 2.8. So all of a sudden, because 0.1%, yes, the rate cut is on. And the reason, the narrative or reason they're giving is because, the tariffs haven't really raised inflation, but I'm afraid to say that very few people know what inflation is, and hopefully those of you who have been following it for a long time know by now, because I've really tried to instill that on the viewers. And for those of you who are new, you might be asking, what are you talking about? Well, the term has been changed, mainly because they're trying to keep you unaware of the fact that they're inflating like mad, and your currency is going down in value, and that's why the cost of living keeps rising. That's why the majority of Americans and people in Britain are suffering. It's very hard for them to make ends meet. And inflation really is when the government, and only the government and the central bank are able to inflate, because it's counterfeiting. That's all it is. They create currency and credit out of thin air. So what's the opposite of creating currency and credit out of thin air? Well, it's having a free market commodity money, be it gold, silver, or whatever you've got as money, and having to have money backing the currency, and having money backing a loan. But unfortunately, for the last 100 years plus, and it's been like in stages, we've come to a point where governments and central banks just create trillions and trillions out of thin air, and that's inflation. That's the currency and money supply going up, and you've seen M2, it's over 22 trillion, and CPI is just a measure of a basket of goods. The consumer price index, it's a basket of consumer goods. And I've heard now, or I've seen that the BLS, they're even estimating more than 30% of the prices of these goods in the basket of CPI. And why are they doing that? Well, because it's very difficult to ascertain how the tariffs are impacting prices. So they said, well, let's just estimate it. So can you really trust this number? I don't think so. Plus, it's not inflation. And therein lies the big trick. 2.7, it's nothing, right? Inflation's low, but those are prices. The real inflation is all the debt and currency they're creating, and they're not going to stop that. And even if you look at the consumer price index itself, not the monthly percentage changes or year on year, this is like a massive bull market, which is a bad thing, of course. And they will never allow this index to go down. And when it happens, and you can see a little drop here, and that was in, from August to October 2008, that was a little drop there in the actual index. They panicked and they actually printed like crazy, and they implemented QE for the first time, cut rates, because you can't have the CPI dropping, because in a fiat currency world, you need to keep people spending. You need to debase the currency to make sure you devalue the debt, because the government is the biggest borrower. And talking about that, I'm gonna tell you why now the U.S. Treasury and President Trump are so desperate for the Fed to cut rates, despite the fact that, well, inflation is under control, the economy is doing great, we're winning at everything, so why do you need to cut rates? Well, because deep down they're in big trouble, the U.S. Treasury, and that's because of the debt, of course. We had this big, beautiful bill. They're not reining in spending. Yes, they're cutting taxes, but they're counting on a lot of things working out perfectly over time. So, as I said, they're in a precarious situation. And why is that? Well, because from September to the end of the year now, the Treasury has to issue around 1.6 trillion and maybe even more of net debt, net issuance. They have to do another 1.6 trillion. That's new debt that they have to finance. And yeah, that's over just 4 months. And that's aside from the total gross issuance or existing debt that's coming due and that they need to roll over. Well, that's about 2.5 to 2.7 trillion. But as you can see in 2019, net issuance from September to December was 400 to 450 billion, and so on. And even during COVID in 2020, it wasn't as much as it's going to be this year. And as you can see, they slowed down after COVID in 21, 22, but they've sped up again in 23, 24, 25. So what the Treasury is thinking here, if the Fed cuts rates by 1, 2, or even 3% in the next few months, we're going to issue a lot of short-term paper, because then that's going to cost a lot less, because by cutting the Fed funds rate, it might help the short-term bills, and maybe even the 2-year notes come off quite a bit, and that will lower their interest expense cost. And it's a big gamble, because if you issue all these short-term bills, they come due very quickly, and if the inflationary situation gets worse, the bond market will react, and they're going to be paying even more, and it could lead also to a recession. The fact that the longer end of the curve, and that's separate from what's going on in the short end, is actually concerned now. As I said earlier, the German 30-year yield, well, that's reached a 14-year high. We're at 330. And just to think that 3-4 years ago, the German 30-year actually had a negative, it had a negative yield, and now it's at 3.3. And I noticed yesterday, President Trump came out after the CPI numbers, and he said, well, now the Fed has to cut, too slow, pound needs to cut. And so I think the markets expect a 50 basis point cut. It's in the middle of September, the next meeting, 17th, 18th of September. But the longer end, I noticed the 30-year yield and even the 10-year yield, they crept up. Yes, they've come off this morning, and I'm speaking just before 8 a.m. London, but the 10-year got up to like above 490, and recently we've been back down to 475. So I think you need to keep an eye on that. What the bond investors or the bond vigilantes or even hedge funds are saying, if they're going to cut rates, and we've got all-time highs in the stock market, all-time highs in gold, all-time highs in cryptocurrencies, this is not going to be good. This is going to really inflate the system. So it could really backfire, and I think Besant and Trump probably know that it will backfire in that the longer end is going to suffer, but the Treasury will get its lower interest costs. That's what they're betting on by these rate cuts that they want the Fed to do. But there's such a thing as the old saying, there's no such thing as a free lunch. And I think that's what the bond market is telling us, even here in the UK. The longer end of the bond market, the gilt market has crept up, the yields. And when I talk about yields, that's not a good thing. Yields going up, prices, of course, go down of bonds. So that's what's happening there. And I think, as I said, gold, silver, and the miners are telling us, they're forecasting us that there is inflationary, there's inflationary pressure ahead. And the other thing is, well, it seems now that the government or the Treasury and the Fed, if they cut, they're gonna go into a new paradigm, and it's more of an inflationary paradigm, because if you looked at the numbers yesterday, and maybe some of you have, the core number excluding food and energy, which are usually, they do that because they say it's very volatile, but that number was higher than expected. It was like, I think 3.3, or could have been a little lower, but it was higher than expected. And I saw someone post that they've rarely ever cut rates when the core number was above 3%, and they're going to do it now, it seems. And there's the law of 72. What's that? Well, you take the percentage, let's say 3, divide it into 72, and you get the number of years that it will take to have the value of your currency. The other way to look at it, of course, if it's an investment, that's the number of years it takes for that investment to double. You take 72 and divide it by the number. Yeah, it'll take 24 years for your currency to be halved. If you're saving and putting money aside for your retirement, you're going to get hit hard. And that's why people are suffering now, because we've had 50 years of this, 50 years of deception about inflation. So yeah, use that rule of or law of 72. It's really easy to work out. But as I said, I'm looking here at the Philadelphia Gold and Silver Index versus the gold price. And we've been covering this for a while. The first person to mention this to me was Michael Oliver, and I've been keeping track of it. And I think when we started looking at it, it was just breaking out of this falling wedge, but now it's really moving. And the reason I'm talking about this is because yesterday, despite the fact that gold and silver didn't do really well, the miners held up really well. And I think that's very positive, not just for the miners, but for bullion as well. It depends on the individual, their risk profile, their age. You might want more miners than the real physical gold and silver. This is for you to work out. I'm just giving you my opinion here, but this is very bullish because usually in the last few years we've seen bullion do well and the miners not react, and then bullion would come back, and we're stuck in that let's say 1800 to 2000 range. But in the last year and a half, that's changed, of course, and the miners are still undervalued, but they're breaking out versus gold, let alone versus the fiat dollar. So even the junior silver miners, they're breaking out as well. I'm just looking at them here on their own, and they are at the highest level since, for 4 years. And that's very bullish. And the technical formation here looks like a inverted head and shoulders. So the silver miners are confirming it as well. And also the GDXJ and GDX versus a gold, they're breaking out to new highs, multi-year highs. So very positive. And don't be fooled by all the propaganda out there that everything's great, that inflation's low, Americans are earnings are going up faster. It's not, because if that were so, you wouldn't have so many people find it really hard to get by. And I see a lot of comments on social media. I see a lot of comments in my videos telling me that that is the case. People, food prices are going through the roof. And the other thing they do now, you go to restaurants, here in the UK at least, is, let me know what happens in the US, but 15, 20 years ago, or even 10 years ago, the price of a main meal, or I think Americans call it an entree, was for everything you got, all the sides and sauces. But now everything is has a different price. So to make it look like the entree or the main meal, the main dish hasn't gone up, but it has. And if you add up all the sides and sauces, it's crazy. So yeah, let me know. Comment below in the comment section. I try to read as many comments as possible, and it's tough. And that's why I do a Sunday live stream, to try to get more of your questions and answer them. And one thing I would say about the comment section as well, and I try to delete them and report them. There are a lot of bots, so be careful out there, because there are people talking about investments and we contacted this person, they're really good. It's got nothing to do with me. So let's quickly look at where the markets are this morning. It's 8 a.m. London time. So we've got spot gold at 3,357, up about $9, and we're right near the highs. The low's been 42. So we're up a 0.25% in the spot price. Spot silver is doing well. It's outperforming gold. It's up 1.2%, almost up 50 cents at 38.37. So that's encouraging. The stock market futures indices, they're virtually unchanged. The NASDAQ and the S&P, they're up slightly. And again, why do these markets keep melting up? Well, I think it's because we're going to get a melt up. We're going to get an inflationary crack up boom. That's what it is. And yes, you do okay in the stock market, but I think in gold, silver, and the miners, you're going to do even better in relative terms. That's the way I see it. And that's what the bond markets are telling us, the longer end. So with that, I'm going to wish you all a very good day. Take care. Bye.